one of the essential components, one of your partners in running an essential business, your revenue forecast, is currently lying to you, and you should not trust any of the numbers or its outputs right now. But before we dive in, let's just spend a moment talking about why a revenue forecast is so essential for a business. So the revenue forecast drives a lot of things for a business. It helps to drive your expenses, how much inventory you're buying, how much product you're bringing on board, how many people you're hiring, your lease and your space, your warehouse space. It also drives things like your sales commission, your go-to-market planning, your competitive analysis for your pricing. It drives your cash forecast. And if you're looking to have any buy or sell side activity this year, it helps to drive your valuation. So your revenue forecast is one of the core components in looking forward a little bit and understanding the future and how your business today can be best positioned to address that future. And as you think about your revenue forecast, here's a few questions to dwell on. Firstly, when did you create your last revenue forecast? What was true about the world when you created your revenue forecast? What assumptions did you have on pricing, on people's buying habits, on the volume, historic or going forward or otherwise? And finally, what has changed in the world over the past 3 to 6 months that should challenge those potential assumptions? So let's look a little bit deeper in what makes up a typical revenue forecast. So a revenue forecast really simply is your volume times your pricing. And of course, with your business, with many other businesses, there's a lot of nuances and subtleties that help drive this forecast. So we dive a little bit deeper onto that pricing times volume, particularly on pricing. To me, pricing is the art form in go-to-market. It's trying to figure out how much people will pay, making sure you price appropriately so there's no value lost, but not pricing inappropriately so you're losing volume. And it's really difficult. There's a lot of different ways you can price, from value-based pricing, cost plus, time materials, etc. But a core component in establishing your price is the cost of your inputs. But as you think about costs and pricing, typically when costs go up, as we mentioned, the price goes up as well to maintain some of that original margin and to keep your profits and your cash flow stable. So what causes those cost increases? One big one is labor. As labor wages go up, sometimes artificially floored with a minimum wage increase or a really robust job market circa the COVID era. And the other component is supplier cost increases, the raw goods. So you're looking at the raw materials might go up, scarcity, maybe there was a drought if you're dealing with crops as an input, scarcity of resources. Tariffs and taxes is another big one. If a government starts to put tariffs, which is basically a tax on a good, that increases the price of the good because now it's increased by 20%, or that cost of the tax that the supplier is going to pass on to you, the purchaser. So for most businesses, the takeaway here is that in our current environment where you're seeing cost inflation from the materials perspective, where you're going to start to see a significant increase in costs across the supply chain, which then likely means that your pricing will be going up this year. But tried and true economic principle that as prices go up, demand goes down. And as demand goes down, that's the volume, that's the number of units that you're going to sell. As you increase prices, you should be expecting to sell less units at that higher price. And it may not work out one-to-one. You may not sell less units at the higher price for an equal amount. You might sell less units at a higher price, but less units overall that will drive down your total revenue. In economics, there is a theory of elasticity, where if you have a product that's really sticky, typically you have a lot of selling power that you can demand whatever prices you want. If you're the only cable provider in town, you want to increase your prices, you can do that because nobody has anywhere else to go. There's no substitutes for people to turn to. But if you're the latest bottled water, if you double your prices and nobody else does, you're going to lose market share because you're going to have a bunch of substitutes that consumers can then use instead of your product. And of course, that's not all. When you think about an inflationary environment, it's not just your product that will likely be raising prices. And especially in the world that we might be going into with low, no growth and inflation, i.e. stagflation, you're going to see a universal increase in prices. So your customers, the consumers' wallets are going to be stretched even further. If you don't really have a very sticky product, consumers might be cutting back more than you think. So as you consider your forecast, I think it's key to note that your pricing is going up, but the overall environment of pricing, the inflation is going up which will lead to consumer spending declines, ultimately impacting your bottom line through decreased volumes. So if I can suggest a few best practices for managing this uncertainty and utilizing your forecast as the best way possible. Firstly, I would take a look at input sensitivity to really kind of figure out what drives your forecast. The second one is to build multiple scenarios. Typically there's 3: low, base, and high, base being the middle scenario. But let's say I sell 50 units at $125. What does that do to my forecast? What does that do to my model? Do I break even? Do I have enough cash? If I'm burning cash, when do I run out? So the ones you want to focus mostly on are the base and the low, because you want to make sure that you're covering all that risk and covering all your bases. Don't change every single variable. Start with those sensitive variables, the ones that really move the model, and maybe move those around 1 to 2 max. When things get really uncertain and the pace of change is really quick, what I tend to do is shorten down to a rolling cash forecast. 4 weeks minimum, sometimes up to 13 weeks, a quarter, and really track each week's cash inflow, outflow. It takes a lot more time, but the accuracy becomes a lot higher because you're shortening the duration is real time, or as real time as possible information. So in a time of uncertainty, narrow that forecast window, shorten it. And then with uncertainty becomes lack of information. Things are changing so quickly, you don't know what your input should be, you don't know how to react appropriately. So this is where good leaders spend a lot more time with their front line, with their salespeople, with their marketing people, with the customers, trying to understand what's going on, what are the buying decisions being made to help you inform your decisions on your forecast. And then lastly, lean on your KPIs. So hopefully everybody has KPIs, key performance indicators, that help you manage your business. What are the metrics you look at? If you don't have any, this is a great time to put together a set of KPIs that you can use to track the health of your business. You have 3 to 5 that you follow and watch like a hawk. Make sure they're accurate and watch for any sign of degradation that would be an early signal for your business starting to wobble a little bit. So in summary, as you think about your revenue forecast, prices are likely increasing, both for your business as well as the overall universe of businesses in your space and substitutes. That means, as a fundamental law of economics, that your volumes will likely decrease. Will your increase in prices outweigh the decreased volumes? Maybe, maybe not, but that's why you want to create a strong revenue forecast that has different scenarios that allows you to start thinking through and answering those unknown questions. So now is the time to do that, to set up that forecast, to start diving into it. And don't just stop there and redo the forecast. Start to think about those assumptions that you've made. They might be timeless assumptions. You've been in business for many years, but things have changed significantly at the core level. Make sure that you have multiple scenarios. Make sure that you understand your assumptions and the range of potential assumptions that you could be facing over the months and years ahead, because times have changed. So don't get caught flat-footed. Don't get caught unawares. Be prepared. Be prepared for most scenarios that will come your way. Thank you. I hope this was helpful as you think about your business in a changing environment. Please let me know in the comments if there's any topics that you want to go deeper on, whether that's KPIs or modeling, or if you just had any questions for me. Thank you again for joining me. My name is Daniel, and we'll see you on the next one.